All right. We're going to take a look at United States Economic Forecast Q1 2025 from Deloitte. This was released 26 March, today. All right, since the last forecast was published in early December, a new administration has taken office in Washington, D.C., and there has been a deluge of economically impactful policies and announcements. The new president outlined many policy proposals during the campaign, and since his inauguration on January 2025, we have started to get a sense of how the administration plans to implement these proposals. Have we, though? Have we gotten a sense? From a macroeconomic perspective, the most significant actions taken by the administration at the time of writing in late February. Interesting. Wow. Yeah, I guess they have to, write this a little earlier, but a lot has happened in a month. It's been about a month. Have been on tariffs and government operations. There have been numerous announcements on new tariffs. Some have gone into effect, and some have been paused, and some are yet to come into force. On government operations, the administration is seeking to downsize and reshape the federal government through technology modernization. And yeah, this is a nice way of saying it, I guess. This is the best case scenario, actually. That's what I should say. This is the best case scenario. Enhanced government efficiency, again, best case scenario. Headcount reductions, acquisition reform, mergers and acquisitions is under Trump is thought to get a bit of a resurgence, and reducing spending. And this right now is not the case. Looking at it objectively, Trump does have a lot of cuts that he wants to do. Like, I think it's around $4 trillion, and right now he hasn't cut enough to really make that, make up the difference essentially in taxes if he wants to actually reduce the deficit. Trump has proposed reducing the size of some agencies and or transferring governmental functions from one agency to another, and is looking for potential fraud and errant payments in government programs. Yeah. And this is they're doing a good job of being pretty objective, I guess. But I think a lot of this is definitely best case scenario. Speaking of other reports, we looked at the JP Morgan Chase, I can't remember his name, but he did a large analysis on this that was released earlier this year before Trump took office, and kind of took everything at face value of what Trump said he was going to do, and looked at the economics and data behind it. And it was objective too, but like his objectiveness even was a little more pessimistic, because he didn't think that they were going to cut enough, and that kind of all of the levers that they have to pull, everything has to go very right for it to all work, I guess. And I think I still agree with that. It's a lot of change. Although it's still early days, we still have many outstanding questions about policy specifics. The new administration appears to be driving a substantial reordering of the economic landscape. Sea changes like these make economic forecasting difficult, particularly in the face of uncertainty. Yeah. We have produced these 3 scenarios, detailed this next sections below, which capture a range of possible futures. Oh, I'm so glad they did this, because yes, this is a good way to be more objective about it and be able to actually analyze it more so. Let's actually see what this is real quick. Unless otherwise noted, all data cited in this article is taken from U.S. government reporting on Havre Analytics. Okay. Probabilities assigned to each scenario do not indicate that the specific assumption in each scenario will occur exactly as described. Instead, the probability is meant to indicate the likelihood that a particular scenario or one that has similar economic outcomes will occur. Okay. I think, yeah, that's key here. One that will have similar economic outcomes. At the top here. Okay, so scenarios. Baseline, 50%. And this is the 2 we read. Our baseline scenario aims to represent a middle-of-the-road outcome. It is our assessment of the likely trajectory of the economy in the absence of major upside or downside risk. I mean, that's a lot to remove, I will say. But on the positive side, it includes an expansion of the Tax Cuts and Jobs Act. This was Donald Trump's tax cuts that he passed last round, or last presidency, and it expires during this current presidency, which he wants to extend. Let's just get a quick fact check confirmation. Yeah, 2018. And they're scheduled to expire in 2025. And many of the business ones are expiring 2028. I don't know if this will be during Trump's term, though, however. But this one is, I think, important because it's more so just like the standard ones, like for everyday, individual income tax cuts. And a modest boost from deregulation. And this is important too, because this is you can't ignore this in the equation, because there's definitely hope that this deregulation will boost the economy, which will bring in more tax income. Like, that is required, that is part of the requirement that Trump needs with like all of their cuts. They need some sort of like revenue still. However, we also assume a relatively modest increase in tariff rates, modest federal spending cuts, and a more stringent immigration policy that largely balance out the aforementioned expansionary policies. This is there's a lot that needs to be cut, and I just don't think that they could fully do that. I'm sure that they I mean, they've already done some, but like, I'm sure they'll reduce it somewhat, but I don't know if it'll be enough for the expansion of the Tax Cuts and Jobs Act. We expect that TCJA will be extended, avoiding a sudden increase in income taxes. And we expect that the corporate tax cut will be lowered for American producers in line with campaign promises. I think he will do this probably too. Deregulation will continue throughout the next few years. The productivity boost from this is expected to remain relatively modest in the near term, as policy uncertainty delays and limits the benefits of cutting red tape. The productivity boost from this is expected to remain relatively modest in the near term. Okay. Okay. While it's not yet clear which tariffs will be introduced or which will stick, we do expect that there to be some level of new and lasting tariffs. We modeled this by adding 5 percentage points to the average tariffs rate on all imported goods, which stood at 3.3% in 2024. Yeah, because I think there is the tariffs, I think, are a way to get either countries to comply or to motivate United States corporations to onshore things. So I don't know how much of these tariffs are going to stick. Now, I think April 2nd is their date, but they've just today's the 26th, they expanded the auto tariffs. So yeah. But this is just one scenario, so let's keep reading. Sorry. We also expect that some spending cuts will prove lasting. Okay, we got that. Over the course of a few years, total net savings of $200 billion are found in federal outlays, compared with a scenario where there were no cuts. The actual dollar reduction in federal spending is much less than this number, because we bake in underlying spending growth due to population growth and inflation. Okay. Yeah, but even $200 billion is not that much, all things considered. Finally, we expect that deportations of undocumented immigrants will be lower than they were in 2024. That's interesting. However, we expect the number of deportations to be about 15% higher than the average seen over the last 5 years. Yeah, that makes sense. Bro, there's a train honking in the background right now. You could probably hear that. I apologize. Yeah, 15% higher. You hear it? Yeah, okay. I was rewatching VOD back the other day, and I heard a lot in the background. Sorry, I need my window open. It's too warm. I like the fresh air. I like hearing the birds sing in the morning, you know? Okay, in this scenario, individuals and businesses front load some trade activity early in 2025 to avoid tariffs. Yeah, and I think that's what Trump wants to do in terms of strategy. Kind of getting all the hard stuff and like the things that will affect people like right off the bat, before, you know, kind of this like the end of the 4 years or kind of before midterms hit, just so all the bad stuff kind of happens right in the beginning, and then they could end on a high in a way, likely. Yeah, so in this scenario, individuals and businesses front load some trade activity early in 2025 to avoid tariffs. As tariffs take effect, trade slows later this year into next. We expect forecast real exports will grow by 0.7% in 2025 and 1% in 2026, while real imports will grow by 1.8% in 2025 and 0.09% in 2026. The inflationary effects of tariffs mean the Federal Reserve can only manage 75 basis points cuts over the next 24 months. That is not even a percent. Yeah, I don't think Trump will be happy about this, but yeah, I think unfortunately it's just like with inflation the way it is, and with how tariffs affect pricing, like I mean, it is what it is. Real consumer spending grows by 2.9% in 2025 and 1.4% in 2026. Government spending cuts and layoffs continue over the next few years, which subtract value from overall growth. Yeah. Corporations, the public market, you know, private sector is going to have to pick up the slack for all of these government layoffs if we want to continue like growth. Overall, our modeling shows real GDP growth of 2.6% in 2025 and 2.1% in 2026. GDP growth then averages 1.9% per year over the remaining 3 years of the forecast. I mean, that's not horrible, but I think it's probably not the best. Let's look at just GDP growth by year. I don't know these sources, but I assume that we could, you know, World Bank. All right. Yeah, I mean, if we look, it's like during kind of like non-COVID times or whatever, you know, pre-COVID, post 2008, it's probably averaging about like, you know, 2%. That's reasonable. Okay, trade deals and deregulation. This is 25%. Our upside scenario explores the possibility that the economy could unlock a new level of growth thanks to productivity enhancing technology like artificial intelligence, robotics, tax cuts, and deregulation. In this scenario, we examine, and it is important to note that there is a correlation of regulation inhibiting innovation. Let me look up let me look up the report I was referencing earlier, because a lot of this is important. Yeah, so this is the report I'm talking about, kind of been mentioning. This was Outlook 2025 by Michael Sembalist. This is a good report. We covered it on stream here, and I guess it's actually maybe doing something similar, but they take a look at everything like deregulation, deportations, tariffs, tax cuts, and look at it as a whole and kind of analyze best case scenarios, kind of similar to what this is now, but there's a lot of good information in this report as well if you enjoy reading economic forecasts and reports like this. So I guess I'm going to kind of compare it a bit and like use some of my knowledge from reading that report on this. In this scenario, we examine what might happen if these hopes come true. As in the baseline, the TCJA tax cuts are extended and the corporate tax rate is lowered to 15% for domestic producers. I think that this is very likely to be passed. Assuming that they're able to pass it maybe before midterms, and assuming like they hold the majority in Congress, I assume this is probably going to pass. That, as well as breakthroughs in novel technologies like artificial intelligence, prompts a boost in investment, which results in productivity boom. We maintain tariffs at 2024 levels in this scenario, working on the theory that the new administration is primarily interested in using tariffs as a negotiating tactic to extract concessions from trading partners. Yes, I think that this is the... Let me finish. Likewise, deportations under the current administration continue at a similar pace as previous administrations. Yeah. But I think that this is very much the case, but I do think that you need to take in the fact that, okay, they actually talk about it down here, that this is already not going to plan. Like, I don't think they intended retaliation as much or as hard as we are being retaliated against with tariffs. It just doesn't seem like it's working too well. Notably, Mexico and... I don't know, there's like one other country, like Mexico's complied, I think. But like no one else is really like buying it, I guess. Especially in Canada. Canada, we've seen the political party completely swing in I don't know Canada's political parties, but like from their left-leaning, or from the right one being their right-leaning party being very popular to now the left-leaning party swinging back after Trump taking over. And I think that's kind of like an indicator here as to these tariffs not being the best negotiating tactic, or at least not working. And you know, we've covered, you know, we've talked about on stream and looked at other reports and articles about how the EU is looking now more so to like be less reliant on United States, like big tech. And now that they're going to tariff us back, are likely going to have to find other sources or onshore manufacturing as well. Mexico is interesting because their auto industry and food industry have their central operations in the US. Yeah, that's crazy. And therefore, they aren't affected by tariffs. Really, it's like negligible. That makes sense. And I mean, as the United States, I feel like we would want goodwill with our neighbors above and below us, at least, because we are very interconnected in trade. I mean, that's kind of like that neoliberal agenda in a way of like globalizing things. Yeah, that's interesting. Okay, and so, you know, assuming that the tariffs work here, likewise deportations, in this scenario, real GDP will rise by 2.9% in 2025 and 3.2% in 2026. So this is the more optimistic, where the tariff negotiating seems to be working. I know right now we're kind of in fights, but the tariffs could still work potentially. Granted, I do think that like the best case scenario is kind of out now, but I guess we'll see in like a week or two when we kind of get they iron out their tariff policy. With fewer tariffs, okay, growth averages 2.9% over the remaining 3 years of the forecast, 1 percentage point above the average base in the baseline scenario. With fewer tariffs in place, this scenario also predicts lower inflation compared to the baseline, stronger consumer spending starting in 2026, and lower merchandise trade deficit. and a lower merchandise trade deficit. The booming economy results in lower unemployment rate than in the baseline scenario. Yeah, this would be good because then it would give chances for the government employees who are laid off to get jobs. Actually, hopefully better paying jobs considering it's the private sector now. Although they might have to change how they work. And I think this consumer spending is also an interesting call out because when we watched the Federal Reserve meeting the other week, a lot of the reporters were talking about they talked about consumer spending, or they talked about consumer sentiment and how it's been the lowest ever. And Jerome Powell said that a lot of times that doesn't even matter because they might say, consumers might say, have an opinion that confidence is at the lowest ever, but then they still go out and spend the money, contradicting kind of the opinion that they shared. And it's kind of like corporations or businesses sometimes are like, it's like the customer doesn't know what they want. And I feel like in some cases that is true. And so I think it's kind of a scenario like that. So I think strong consumer spending is still on the table. Assuming that prices and inflation don't continue to go up, I think, too. Okay, so trade wars and persistent inflation. Or baseline does incorporate some significant policy changes from the new administration, it does not reflect the full scope of potential changes to trade and immigration policy. We therefore modeled an alternative scenario where more impactful versions of these policies were implemented. In this scenario, we raised the average tariff rate on goods import by 10%. And I also think you could say this tariff is also just a tax. Like, that's literally what it is. And so looking at it like a tax, I think, also changes the perspective a bit, because it does kind of go against like the lowering taxes of what more right-leaning views like have. But if they want to kind of do this golden shield, maximize our exports, then it's kind of just like the price they're going to have to pay, or at least the citizens and consumers will have to pay, assuming that it'll kind of balance out and we'll get a something better at the end after it's happened. As a point of comparison, this magnitude of tariffs is approximately equivalent to a 25% tariff on Mexican and Canadian imports. The average import duty has not been this high since World War II. Yeah. Tariffs raise the price of final goods for American consumers and raise the cost of intermediate exports for American producers. Yeah, they'll raise the price of the final goods for American consumers and raise the cost of intermediate imports by American producers. Exporters are also affected by the appreciation in the US dollar caused by tariffs, making American products less affordable for foreign buyers. And I think this also... This is definitely a strategy. I think, though, the Trump administration has the view that the dollar is too expensive and they actually want to bring it down, though. So I'm not sure if this is in line with the Trump administration's views. But overall, I think this is likely not good because we want the prices to go down for exports if we want to maximize exports. The kind of mercantilism view that we have. I think it's people around Trump. It's definitely a theory, but people around Trump have the views of that. Trump. I don't know who exactly. I heard it in an analyst video that I watched, or the Ezra Klein show interviewed the PhD anthropologist and financial reporter. Yeah, no, I just trusted them, I guess, but it is I don't know the source. I don't know these sources I'm looking up right now. Why does President believe America has been dealt a bad deal? His chief complaint is that dollar supremacy may confer huge powers on the American government and ruling class, but ultimately foreigners are using it in ways that guarantee U.S. decline. Because I think the idea is that the world just uses the dollar as the world currency, in a lot of ways, or at least like America's economy. People who interact with America a lot are allies of us, and that kind of drives the dollar price up. And ultimately that's bad for the US because now the dollar's expensive for America. What most consider to be America's exorbitant advantage, he sees an exorbitant burden. Yeah, Trump has been lamenting that the decline in US manufacturing for decades, and this is kind of that mercantilism view, I think. If you don't have steel, you don't have a country, but why blame this on the dollar's global role? Because Trump answers foreign central banks do not let the dollar adjust downwards to the right level, at which U.S. exports recover and imports are restrained. It is not that the foreign central bankers are conspiring against America, it's that the dollar is the only safe international reserve they could get their hands on. It is only natural for European and Asian central banks to hoard the dollars that flow to Europe and Asia when Americans import things. By not swapping their stash of dollars for their own currencies, European central banks, Bank of Japan, People's Bank of China, Bank of England, suppress demand and thus the value of their currencies, which in turn means that like the dollar is worth more, so it's more expensive. This helps their own exporters boost their sales to America and even more dollars. In a never-ending circle, these fresh dollars accumulate in the coffers of the foreign central banks who, to gain interest safely, use them to buy government debt. Yeah, it's kind of like... So I feel like it's kind of using it against us, and it's just kind of not a positive for the United States. And our deficit, while has never really been a problem, it is now, we are paying an interest more than our defense budget, and that is not good. I'm all for government spending, but like we do have, like, we're wasting a lot of money now, kind of. Yeah, and so the dollar's hegemonic status also underpins American exceptionalism, as Trump knows and appreciates. Foreign central banks' purchase of U.S. treasuries enabled the U.S. government to run deficits and pay for an oversized military that would bankrupt any other country, and by being the linchpin of international payments, the hegemonic dollar enables the president to exercise the modern-day equivalent of gunboat diplomacy to sanction at will any person or government. Okay, I don't know what this is. But yeah, I guess this kind of explains the point a bit. And kind of another example of that is I read recently where like Japan's yen is generally worth less than the dollar, so you could use yen to buy treasury bills, yen which is worth less, to buy treasury bills and then get the interest on that. But now that yen is actually raising in price, it's not that possible. I think Japan's the biggest owner of US debt outside of the United States. Okay, exporters are also affected by the appreciation of US dollar caused by the tariffs, making American products less affordable for foreign buyers. And this kind of, again, contradicts what we just read a bit, so yeah. Okay, as a result, exports are flat in 2025. While we do not model retaliation by trading partners in our scenarios, it is reasonable to assume that they would levy reciprocal tariffs or boycott American goods. The extent to which these dynamics further reduce American exports depend as much on psychology as on economics. That's a very good point. I think that's interesting call out though. Fucking doing psyops. Okay, while the tariffs could result in the reshoring of manufacturing to America, the macroeconomic benefit of this will take time to materialize. We include larger government spending cuts in this scenario. With spending eventually falling to $1 trillion below its status quo trend. I'd like to know what they're specifically including in this, because I think this is important. A lot of the workforce that we're cutting, I feel like, isn't that much money. Like we're talking when we're talking like trillions. So I'd like to know what they are talking about here. To me, larger government spending cuts would be like large defense cuts, things that just take up much more of the pie versus kind of like the small ball stuff they're doing right now. Well, a small portion of these cuts come from reductions in headcount. Yeah, in the consolidation of departments and agencies, other spending cuts will necessarily need to be enacted through the congressional budget process. As in the baseline scenario, the TCJA tax cuts are extended, and the corporate tax rate is cut to 15% for American producers. Yeah, and I think in any scenario, this gets approved. Well, the vice president has floated the possibility that 1 million undocumented immigrants could be deported each year under the new administration. We think it would be very difficult to deport such a large number of people. Yeah. In this scenario, we allow deportations to rise by 250,000 per year, roughly doubling the rate of the previous administration. I think that's a good, fair estimate. I think there's a much more logistics in legal battles that are going to need to be figured out, like the Alien Enemies Act or something, I think, that Trump tried to use, and the judge went back, even though they send the flights. I think things like that, it's gonna not make them be able to reach 1 million, but yeah, this is probably a good conservative estimate. This reduces population growth and would have an impact on some industries like agriculture, hospitality. I think construction was a big one too. Where undocumented immigrants make up a significant share of the total workforce. I'm actually this one has a lot of interesting charts. They might even have the one that I mentioned. Yeah, this one is important because unfortunately these tariffs have much more impact on red states, and I think that will in turn affect potentially midterms if we're seeing that by then, theoretically. Oh yeah, here we go. Inflow of undocumented immigrants to the US. Yeah, this is what I was looking for. So yeah, Trump, there's definitely a peak, but actually, if we look at it, Obama was doing a lot. Granted, it's still not even near 250,000 a year. We're still, we're still in rookie numbers here. But oh yeah, here we go. Landscape housing, households, building services. Yeah. Crop production, animal slaughtering, general food, bakeries, dry cleaning, construction. And this is 2023. That's what I was looking for. Perfect. Just as some backup data. Okay, overall economic growth slows considerably to 2.2% in 2025 and 1.3% in 2026. 1.3% is pretty low. That's yeah. We haven't seen that in a while. I'll just say that 2011. This financial crisis, but we haven't seen that in a while. The fight against inflation is slower than expected, and the Fed holds off on rate cuts in 2025 before beginning cuts again in 2026. This seems likely too after the latest Fed meeting. So here we go. Real GDP, baseline, trade deals, and deregulation, trade wars, persistent inflation. I also think that this also indicates that while it seems bad, in my opinion, a lot of things are generally they're not bad, but they're not good. Overall, we'll probably be fine, assuming that some things go right. Tariff wars don't drag on too long. Okay, cool. Then we got sectors. This is honestly way more interesting. So we got consumer spending. Real consumer spending continues to fare well. The fourth quarter of 2024 overall Real personal consumption expenditures rose 4.2% at an annual rate, even stronger than 3.7% growth recorded in the third quarter. Spending on durable goods in particular remained elevated, growing 12.1% in the fourth quarter after rising more than 7% in the third quarter. Let's just look example of durable goods real quick. Yeah, bricks. Cool. Okay, yeah, it's like construction stuff, like steel, refrigerators, cars. I see. Okay. And I think durable goods are likely going to be hit by tariffs too, because that's a lot of like, more manufacturing that is done probably overseas. Trump put tariffs on washing machines previously, which seems like would be considered a durable good. Despite this strong base, uncertainty is affecting consumer confidence. As of this writing, a fear of price increases from tariffs caused by the University of Michigan Consumer Sentiment. This is the consumer sentiment survey that I mentioned that reporters were talking to Jerome Powell about. This one caused the University of Michigan Consumer Sentiment, a monthly survey of consumer confidence levels in the U.S., to fall 9.8% in February to 64.7% with all ages, income brackets, and wealth levels, and all 5 index components posting a decline. Leading the decrease was the 19% decrease in buying conditions for durables, as year-ahead inflation expectations rose from 3.3% in January to 4.3% in February, the highest level recorded since November 2023. In addition, the Conference Board's Consumer Confidence Index declined 7 points in February to 98.3, the largest monthly decline since August 2021. Again, this is just opinion of consumers. Their actions will likely result in something different. Okay, short-term gains in consumer spending are expected to be driven by growing income and the ability of households to add new debt. Yeah, and debt is high. Yeah, household debt continues to rise, increasing by $93 billion in the fourth quarter of 2024. We expect the Fed will cut rates twice this year, enabling households to take on more debt. Is that what they said up here? I guess. Oh, actually, sorry. This is definitely for the scenario where they said that Fed holds off on rate cuts in 2025. We expect the Fed will cut rates twice this year, enabling households to take on more debt, and therefore allow households to continue spending in the short term even if significant tariffs were imposed. Interesting. 2 cuts this year. Yeah, I think that's too optimistic, but I would trust Deloitte more than me, so. And therefore allow households to continue spending short term even if significant tariffs were imposed. Okay. We also expect consumers will be doing some front loading in early 2025 to get ahead of tariffs, which we see being slowly implemented over the course of this year. This is a good point. I don't know like how much this is actually true though, because I've seen a bunch of articles. It's like, oh, these are going to be affected by tariffs. Like, get them while it's cheap. But like, I don't know if people actually acted on that. Overall, we forecast real consumer spending will rise 2.9% this year before growing a slower 1.4% pace in 2026. Lower interest rates should help boost demand for durable goods, boosting spending on that category by 3.3% in 2025 before tariffs bring growth to just 0.8% in 2026. Dang. Spending on non-durables is expected to rise by 2.6% in 2025 and 1.2% in 2026. Finally, spending on services is expected to increase by 2.8% in 2025 and 1.7% in 2026, as services will be less impacted by tariffs. Very good point. Although, notably food might be affected more so in terms of services. Uncertain consumers have brought our consumption forecast down from our previous forecast. Yeah. I don't know. I still think that we are just correcting from the COVID peak still. Like, to me, we're just kind of like coming down and we're like normalizing more so. I think I said that yesterday, and I think I still hold that opinion. Because if you think about it, like, companies are like only recently laid people off. Like, I was laid off from, like a healthcare company later last year. Like that, like my company's gonna like barely start seeing the effects now of like the saved money that, from the layoffs and such. Like, they're just now like starting to see that probably. And they're still making adjustments. They're still like, changing spending habits. And like, we're kind of this like still seeing that a bit, I think. And with mixed in with other kind of unfortunate things like tariffs, inflation, interest rates. Yeah. This is 2018 is, Trump's in office still here. COVID, post-COVID, and we're coming back, and then we're kind of normalizing. This is kind of low, though. Net household wealth, unemployment rate, they actually expected to go up. Similar though, I think, to the layoffs from like the private sector, the government now with all their layoffs. I think that's going to take some time for the rest of the economy to kind of absorb everyone to get jobs. Like, right now, Jerome Powell said that like employment and like job growth is in a good spot, although it takes much longer for people to get jobs. And I think that's the job market is for people looking for jobs, for employees, is just not the best right now. I think I still hold that opinion as someone in that market, and I've spoken to a few other people who are looking for jobs straight out of college, and it's hard. Okay, so we have housing. Housing is a interesting one, and I think it's something that has been kind of a problem now post COVID, especially with interest rates, and we haven't really seen much to address this, and so I'm curious to see what they think. Okay, while interest rates have started to decline, mortgage rates remain elevated at the time of writing, causing housing starts to fall 9.8% in January to 101.366 million after strong increase in December. Although building permits remained relatively flat, elevated borrowing costs continue to weigh on affordability for buyers. Yeah, but okay, we'll keep reading it all. During the 2010s, housing starts did not return to their peak levels from before the global financial crisis of 2008 to 2009. The long-term failure to build enough homes has contributed to the housing crisis we see today in some parts of the country. Yeah. This is what I was gonna say. Like, I even if mortgage rates are high, and maybe prices are mortgage rates, or housing prices are high too, I still think that there's a scarcity aspect of it too, like scarcity aspect of housing that you can't not say. Like, there's just not enough of the thing. The long-term failure to build enough homes has contributed to the housing crisis we see today in some parts of the country. And we may have to wait for rates to drop to see significant uptick in housing construction. That's unfortunate, but yeah. And I think the lumber market has also kind of been in flux these past few years. And I imagine, I don't know how much lumber we import, but I imagine that could, if the lumber prices are still in flux, that could also have an effect. One opportunity for new administration could be to pursue initiatives to promote the building of housing. Yes, that is exactly what should be done. Yeah, the housing one's a bit complex. I think there's a lot of levers that the government could pull to help this. It just seems like it's too politicized and there's too much red tape now. But I also think that states could probably do more. After rising at the end of last year, we expect housing starts to continue falling throughout the first half of 2025 before rising again in the latter half of 2025. Overall, in 2025, we expect housing starts to rise to almost 1.3 million and almost to almost 1.4 million in 2026. We anticipate I wonder what this growth rate, like, is this growth rate in line or is this slower? We anticipate housing starts to continue rising for the remainder of the forecasted period once the Federal Open Market Committee lowers rates once again. They do have a lot, though, riding on lower interest rates. And that just seems very unpredictable to me to like bank forecast on things like that. There's a lowers rates. Let's just look this up real quick. There's a website. I don't know if we'll be able to find it, but they have a probability of rate cuts. This is not it. This isn't it. This is it. Yeah, right here. Current target rate. Okay, so this is target rate probabilities for 7 May. So this is the next Fed meeting. 87% think that it's going to stay the same. This is lower. Current rate is this. So let's look. So this is the May one. Let's look at the June one. Okay. So see, now we're seeing some more. We think it's more likely. They think it's more likely to lower in June. Like more spread out, but more likely to stay the same compared to June. This is more likely to lower. And as we get towards these, though, the probabilities are going to change significantly. So, yeah. But interesting, though. This is just good to bank in the back of your head, just to see, just to think. Let's see. Lower interest rates once again. For the entirety of the forecast period, we expect the housing stock to rise more rapidly than total population, helped in part by the slower population growth, likely due to the deportations that we mentioned earlier. This is interesting. We expect housing stock to rise more rapidly than population growth. So this is, likely when it would be a good time to purchase a home, or that prices will be more reasonable, hopefully. Despite strong projected construction levels in the medium to long term, real affordability requires more starter homes. Yeah, to be built in parts of the country experiencing the largest increase in population. My brother works for a home builder, and so I tapped into that market. But most of the what they build are right now are not in the price range of affordability for starter homes. They're definitely more expensive than starter homes, and I think this is probably an important call in the housing too, because assuming that people are looking to buy a home who don't have one, I feel like they're more likely to be starter homes, and they're going to be younger, like myself, versus those who have homes who could sell and then use their, assuming they have positive equity, to roll over, and like that's their down payment and whatever. Like those people have a much easier time buying homes, I assume. Yeah, exactly. Starter homes don't exist anymore, right? Yeah, it's like just saying, like, yeah, my brother Sean, it's like most of his homes he's building are not in the starter home price range, even though their size might be considered a starter home. It's like they're still hell expensive for small homes. No, it isn't. 2 bed, 1 bath is an apartment. I think, like, I don't know, like we have like 2 bed, 2 bath right now. Like having 2 showers is like underrated. I'll be honest. Um, where are we going? Oh yeah, we expect the benchmark home price index will rise by 3.7% in 2025, with a further 3.3% growth in 2026. Dang. Ours 2 bed, 2 bath is tight. Yeah. I guess if you're building a home, it's all built in the 50s though. I don't think it matters. Like if you're building a home, like you might as well like make it like a little bigger. But I don't know, I guess a home's a home. It's not everyone, it's not for anyone to judge, I guess. In the outer year of the forecast, the house price index is expected to rise more rapidly once again. Yeah, it's unfortunate. Real investment in private housing. Housing starts. Stock of owner-occupied homes. Yeah, see, like this is a important metric because I feel like these guys kind of have better like liquidity to buy one of these like other homes that like might otherwise not be a starter home, or the price is just raised so much that like they're this, while they may own or live in a starter home, the price no longer reflects that of a starter home. And I also think, unfortunately, I don't want starter homes to just be tiny now. Like, the only way to make them affordable is to build, like, a fucking shipping container kind of home. Like, like, I also don't think that is a positive. Like, the quality matters a lot. Same with jobs. I think job quality is important, too. Like, you could say that you added 100,000 jobs, but if it's minimum wage, zero benefit jobs, like, is that even, like, that good? This is better than nothing, but... yeah, and interest rates here. This is very notable. Mortgages. Bro, this is, you bought in 2021, like, bro. I mean, housing, I think prices are, probably high, but yeah, it's fortunate. All right, business investment. Investment is spending that helps grow the long-term productive capacity of the economy, and as such, is one of the most important indicators of an economy's future potential. Investment also often follows a cyclical pattern driven by commodity price booms and economic cycles. It also can be incentivized by policies like lower taxes or subsidies for investments. Business confidence is a crucial determinant of the level of investment growth, as businesses need to feel positive about their future potential to justify spending money to grow their operations. Yeah, this right here. Unfortunately, business confidence is weakening in the face of uncertainty. Certainty is something that, yeah, businesses need to like confidently invest in things in the future. And when the uncertainty is high, there's like they're less likely to spend that money for something in the future. The National Federation of Independent Businesses Small Business Optimism Index dropped in January and in February. In addition, several regional Federal Reserve Bank surveys reported a sharp drop in the outlook for business conditions. Yeah. It's not, talking a little shit about Trump, but like he did previously in his last administration, he put a lot of focus on the stock market as important, that as an important indicator that his policies are working. And with a lot of uncertainty now, the stock market's not doing too hot, and he's like says that it doesn't matter anymore, but I actually think it still matters a lot, because that, again, like it's like the business spending is kind of a lot of the backbone of the economy, and it's important indicator to look at. I know that like they say that there's going to be turbulence while initially tariffs come and all that kind of stuff, but you still need some predictability in the future. It's very unpredictable right now. Interest rates also influence investment. Yep. No more ZERP. No more zero interest. Interest times. And I think venture capital and tech, this is like really where it hits the most. Because most of like modern tech, like post 2000, post .com, it's been pretty low interest rates overall, for the most of the time. And so I think now that we have higher interest rates, and they're probably going to stay relatively higher for at least until next year, it's going to be a bit turbulent for them. Now AI is like kind of saving them, but we'll see. Okay. The average corporate borrowing rate increased nearly to 7% by the end of 2023 and remained above 6% throughout 2024, presenting a barrier to firms who need to borrow to invest. We actually just read how CoreWeave, who's going to IPO potentially this Friday, has 11% interest, but they're, but I mean, theirs is kind of a special. They don't make money or anything, so that could be it. But 11% interest. However, many firms still have more cash on hand than they did before the pandemic, and they can consequently avoid borrowing at these rates. we were reading GameStop just before this. They have like 4.8 billion in the bank or something. And their business almost shouldn't even exist. After posting a 1.1% decline in the last quarter of 2024, we predict investment in structures to fall another 1.4% in the first quarter of 2025 before slowly rising once again. Overall, we predict investments in structures to fall 0.1% in 2025, but rise 4.2% in 2026, which is significantly below the 10.8% gains recorded in 2023. Wow. Yeah. I mean, it seems like it's likely just as the tariff uncertainty wears off, or we get a more clear picture and idea of what we're going to do in the future, which I could see why the 2026 could rise. Makes sense. I'm going to close my window. Got some yard work. Okay, besides structures, construction, other types of business investment include spending on machinery and equipment, such as computers or industrial equipment, and on intellectual property, such as software or AI. Both types of spending have seen a strong upward trend over time. Although machinery and equipment spending fell by 7.8% in the final quarter of 2024. That's interesting. But sometimes I don't like when they share like it fell this much. Like, what was it the quarter before? Like, is this normal? Are there any like outliers in that quarter? We expect the stronger growth trend to return for the rest of the forecast period. The resumption of bonus depreciation that has been gradually phased out under the TCJA is expected to support such spending. There was a resumption of bonus depreciation that has been gradually phased out under the TCJs. Yeah. Huh. Our forecast shows M&E investments rising 2.3% in 2025, with growth picking up to 6.3% in 2026. We see intellectual property spending rising 4.3% in 2025 and 4.9% in 2026. I wonder if machinery and equipment is like manufacturing equipment. Is it like tractors? Airport transportation, construction, manufacturing. Yeah, because I imagine manufacturing, if it's going to be, we're onshoring, that would increase a lot. Or at least more than before. With tariffs. Overall in 2025, because I guess that's the whole point of tariffs, is like, or what Trump wants is he wants to bring all the manufacturing to the United States, so it's like made in America, whatever. And yeah, I wonder if they are going to talk about that. Okay, labor markets probably, because I do think that there's I'm curious about if there's actually enough people willing to work jobs that would support this manufacturing. That's an important. Overall in 2025, we predict business investment to rise 3.4%, slowing slightly from the 3.7% recorded in 2024. However, once uncertainty starts to ease, we expect growth in the business investment to pick up, rising 6.3% in 2026. Cool, that makes sense. As uncertainty diminishes, they'll increase spending because they'll be able to make more assertive decisions. Even though corporate profits are like the highest. Interesting. Okay. Foreign trade. This is a spicy one, I'm sure. Foreign trade remain the sector with the biggest question marks surrounding it. Tariff details are being changed on a near daily basis. At the time of writing, some of the measures that have been announced but not necessarily taken effect include a 2.5% 2.5% tariff on goods imported from Canada and Mexico, 20% additional tariffs on Chinese imports, 25% on steel, aluminum, automobiles, pharmaceuticals, and semiconductors. I think automobiles have a carve out now. I'm not sure. There's just some news headline today about it too. And expected reciprocal tariffs against all countries, tariff and non-tariff barriers to trade. Given the difficulty predicting the specific package of tariffs that will be introduced, or the possible length of time they will remain in force, we've chosen to build our forecast around the potential increase in average tariff rate rather than the specific selection of imports. Yeah, this probably seems smart because it's just normalized, like it's kind of like averaged out, I'm sure. So in our baseline scenario, we raise the average tariff rate on goods import by 5 percentage points from approximately 3.3% to 8.3%. This also, I think, is the like lower scenario that they said above. Like lower likely to happen, but it's happening now, I guess. This level implies that many of the proposed tariffs will not end up being eliminated, or will not be left in place for long. Yeah, I don't know. Readers can also refer to our downside scenario, which contains a 10 percentage point increase in average tariff. Okay, so I guess this is like a little less than that. For an indication of what might happen if larger range of tariffs do take effect, or take effect for longer. That downside scenario would be roughly equivalent to a permanent 25% tariff on imports from Mexico and Canada. Yeah. Although the tariffs in our baseline scenario are less ambitious than some of the number recently floated, their impact are expected to be significant and much greater than what we saw during the president's first term. Yeah, well, I imagine that we're just tariffing more too than compared to the first term. The imposition of these tariffs is likely to turn into a complicated process involving individuals, businesses trying to make substitutions and supply chain decisions based on relative prices. And I think exemptions too are a big thing. Like there's going to be a lot of carve-outs that, as we've already seen. As tariffs take effect at some point this year, we expect growth in exports and imports to rise by only 0.7% and 1.8% in 2025, respectively. Growth will remain limited in 2026, with exports rising only 1% and imports growing slowly to 0.9%. Yeah, and I think it's going to take a while for like fully if whatever Trump is doing in like his cabinet with wanting to like onshore stuff to be able to like maximize exports, like that's going to take probably more than like a year or two. But I wonder if they're going to talk about like raising prices in general, because last time around I think with like washing machines, like they put tariff on washing machines, but then which the prices rose, but then as a result, dryer price also rose because they could kind of just like, it's like, oh, like the prices are just kind of going up, and so just like an opportunity for them to raise prices. But that might have been in like business. Okay, although okay, it may be surprising to see that exports may suffer as much as imports by the imposition of tariffs. There are a few reasons why this is the case in the short term and why these tariffs may not have their desired impact in the long run. First, about half of the imports are currently used as intermediate inputs by US businesses. It is likely to take some time for US producers to find local alternatives to the goods they are currently importing. In the meantime, their costs of doing business will rise. This dynamic could reduce the money available to firms to invest in This dynamic could reduce the money available to firms to invest and may drive some U.S. producers out of business if the costs are not passed to the consumers. It's so unfortunate. Literally, it's like they have to pass the price to consumers to stay in business. That sucks so bad. It will also make their exports costlier and less competitive. Second, when the United States imposes tariffs on other countries' goods, it has the potential side effect of causing the US dollar to appreciate, leading exports from the United States to become relatively more expensive in other markets. Tariffs will shield US producers from the import competition required to make globally competitive products. So, while they may dominate the US economy, they're also likely to lose export sales, leading to limited net gain for American manufacturing. See, but I feel like this is almost what Trump wants. Many of the potential benefits of tariffs would take much longer than 4 years to be realized, and so do not occur within the forecast horizon. In most industries, there is not a large pool of American manufacturing production currently staffed up, but sitting idle. Dang. And I think, though, the staff, I hopefully talk about the staff so much, factories will need to be built, and workers hired and trained, both of which will take time. During this transition period, when there are no U.S. alternative goods, the cost of tariffs is likely to be borne by American households and businesses. In many cases, the reason for offshoring has as much to do with the availability of certain skills as it does cost, and reshoring all this production will require major skills training programs to ensure adequate supply of workers. Yes, I think this is an underrepresented opinion because it's also not even skills, but like sometimes like these jobs just aren't the like highest quality of jobs. Like it's hard work, you know, like it's like monotonous. It's so I think that like, it's, and especially when we think about like I don't know. I can't remember exactly. I'm not gonna be able to find what it is. Um, it's like 3-tier. Three sector model. Here we go. With this 3-sector model, this is a theory. It's not like, it's not proposed. It's not like as fact, but it helps, get my idea across. So there's like different there's different sectors in the economy that are divided out in terms of like how technologically advanced a society is. So like divides economy into 3 sectors of activity: extraction of raw materials, manufacturing, and services. And then there's also expanding now with like, if we go down here, the quaternary, where it's like the research and development. There's also like one that's kind of like knowledge work, knowledge society, which is like kind of what the United States is leaning towards, as we're very developed. But as you progress in society, each economy, so you could say each country, produces certain amounts of other things that make up for the more technologically advanced society not doing something. So like, for example, United States, we don't do a lot of manufacturing because with our globalization, we just offshore that to China. China has a skilled market for manufacturing, and they have businesses that do that very cheaply. And so the United States could focus on this higher, these like more higher value sectors in markets, like our economy in general. I'm explaining this poorly, but we don't have to focus on like raw material extraction manufacturing. We could offshore that to a more developing economy, and we could like they're just kind of like a tool, I guess. And I think that's kind of the neoliberal kind of globalization that we've had before. And now that we are not in that, Trump wants to change that, essentially. And this seems like a problem because this is Trump's theories, like other economies kind of rely on us, but also we rely on them. Like we don't do like material like raw mineral extraction like they do in like, Africa, and like, gold and diamond mines and whatever, because one, we don't necessarily have the material, but also like we need to find people to actually work those jobs. And when people are offering nice cushy office jobs, even though the job may be worthless, it pays a reasonable amount and it's easy and you could, it's chill. Someone wants to work that over going to work in a mine. So I think that like that's going to be hard under Trump's policies to work that out. And that's why there's going to be a lot of like regime changes in a way. We're going to see a lot of significant and large changes. I also realized I never changed my Twitch title. All right. Many of the potential tariffs will take much longer before you. Okay, here we go. Yeah. In many cases, the reason for offshoring has much to do with the availability of certain skills, like China does with manufacturing. They're just very good at manufacturing. As it does in reshoring, this production will require major skills training program to ensure adequate supply of workers. So this is, let's just look at this chart. Like this, it's going to take time for these tariffs to kind of come in. And we're going to be importing a lot less. The import is very sporadic, though. It's not very really consistent. This stays about the same. Okay, government policy. The new administration is seeking to cut government spending by establishing a Department of Government Efficiency, DOGE, to coordinate this task. So far, more than 75,000 government employees, about 3% of the total federal workforce, have reportedly accepted buyout offers. The administration has also said it will lay off all federal employees still on probation, a group that numbers 220,000 people, though the court have since delayed these efforts. Federal government spends about $270 billion on salary for workers. This is nothing, like, mind you, kind of, like, in comparison to everything else, like, it's not that much. And you do have to think about the cost. Like, this costs money. Like, these 220,000 people that we are going to be laying off, they are now going to need to get unemployment. They are going to have to get open market health insurance that, you know, like Medicare, Medicaid, whatever. That costs money to the government. This all costs a lot of money to the government. It's probably going to be potentially more than that. Assuming they go through with all the cuts that they are. Assuming these layoffs all occur and are not offset by new hiring for the administration's priorities, they would save around $30 billion per year, or 0.05% of total federal spending. Yeah, and mind you, with this report we're looking right here, this other JP Morgan kind of like market report, they estimated let me find the chart. They made it really easy to understand. Here we go. This chart right here. Trump 10-year budget deficit and of effective proposed policies. Yeah, they mind you, they don't actually include that layoffs, but the like $100 billion when they're trying to save $4 trillion is pennies. Like, they still, this is trillions. It's trillions. Tariffs potentially only bring in $2 trillion for the United States. This is their forecast. And this financial report, they said that they estimated their tariffs. Yeah, 8.3%. Because they're doing average, their potential increase in the average tariff rate rather than one specific selection. Yeah, and their biggest downside contains a 10% tariff point increase, which is exactly what they forecasted here too. And mind you, that is only $2 trillion. They need to cut $4 trillion. They don't include Doge in here because I don't think Doge could cut this much money. They have it extended down here. They explain it more. Here we go. It says, we'll just read this and we'll go back to the report. They've set out on a quest to cut U.S. government spending. The goals reduce $500 billion in federal spending that Musk cited in a Wall Street Journal piece as being unauthorized by Congress, and cut as much as $2 trillion from the $6.75 trillion in fiscal year 2024 government spending, a figure Musk mentioned at an October rally at a Madison Square Garden. And it says, no, as per my top 10 list prediction on page 43, I don't think Doge will get anywhere close. So this is a different opinion. It's in its opinion. From the forecast that saying that they're not going to get anywhere close. According to the Washington Post, other billionaires drafted into the Doge effort include Palantir, co-founder Joe Lonsdale, Mark Andreessen, Bill Ackman, Uber CEO. So, yeah. And even if they undid all of this stuff, it's like, it's still nowhere close. You know, $100 billion annual savings, 10 year, it's $1 trillion. Like, it doesn't make up for what Trump wants to do, unfortunately. So, okay. Anyways, back to this. Yeah, so this is only 0.05% federal spending, not that much. $30 billion is like 10 F-35s. Several agencies, such as the United States Agency for International Development, USAID, and Consumer Financial Protection Bureau, CFPB, which we talked about a lot earlier when we were talking about stablecoins, have been severely downsized. As of this writing, the president is expected to issue an executive order that eliminates all functions that are not statutorily mandated by Congress. The extent to which these actions have a material impact on spending remains to be seen. Some of these cuts have been put on hold by the courts, as some of the spending represents congressional mandated spending. And I think the lower courts is like kind of been Trump's enemy, that they didn't fully expect to block like everything, or at least a lot of stuff. And wait, so they've already done that. I think he did that for the CFPB. The U.S. aid, I think he's gone back on, because I think there's other legal problems with this, but the CFPB is pretty much gone. But yeah, ultimately, like, I mean, let's look it up. So CFPB, if we go to Wikipedia, they should have the budget on here. Yeah, their budget is $600 million. That's nothing. Like, you know, all things considered, it's not that much money. US aid, I think, is a lot, but 40 billion, yeah. Marco Rubio's he's the acting director, bro. He's Secretary of State and that. Okay, some of the cuts have been put on hold by the courts, yeah, as some of the spending represents congressionally mandated spending. According to the latest projections from the Congressional Budget Office, the federal government is on track to spend $39.5 billion on international development and $144 billion on educating and training in 2025. I don't know what this is on education and training. Yeah. Okay, but I mean, I know this is a forecast and like whatever, but like this doesn't seem like, I don't know if this is bad, like they're saying this is bad, but like generally education is like, in training is probably good. That adds to our economy if people are learning new skills. Eliminating this spending would require bipartisan support in the Senate, and the Senate is very tight. Yeah, okay. In addition to the potential savings mentioned above, it is quite likely that the new administration and congressional Republicans will have their own priority areas that will attract new spending, so the net savings will likely be somewhat less. Like immigration, you know, we are increasing spending in immigration to do a lot of the deportations and such. Granted, it's overall it's still not that much, but like in the grand scheme of things, like $40 billion like isn't that much. Yeah, in addition to potential savings mentioned above, it is quite likely that the new administration and congressional Republicans will have their own priority areas that will attract new spending, so the net savings will likely be somewhat less. We therefore assume a total of $200 billion per year in net spending reductions. Which is... Actually, if we go back to this other report, is that what they predicted? Oh, they actually predicted 100 billion. Okay, so they think more. Which would essentially bring this to 2 trillion for a 10-year savings, which is still not enough. We need 4. Of course, government spending is always naturally increasing with time due to population growth and inflation, but so should tax income. So this figure represents savings versus a counterfactual where the cuts did not occur and not dollar reductions in overall federal spending. Read that again. Of course, government spending is always naturally increasing with time due to population growth and inflation. Yeah? So this figure represents savings versus a counterfactual where the cuts did not occur, not dollar... Oh, okay. Not dollar reduction in overall federal spending. Got it. So they're comparing if we continued to spend versus if we didn't, not necessarily like amount of money, like the dollars that the government's spending. On the revenue side, yeah, it's important to look at this because the government spends money, but we need to counteract that with bringing in money, i.e. taxes is likely where it is. And that's kind of the balance. That's the problem that we're having, and that's what Trump wants to solve with all these the Doge, because Trump wants to do things that require spending the government Trump wants to do things that will reduce the revenue of the government, if you want to think about that. Like, it's going to reduce what we're bringing in because of tax cuts and because of there's some of their funding that they want. If we go back to this, he wants to cut. This is the stuff he wants to cut. Like, he wants to cut this stuff, but he wants to increase this stuff, like repeal clean energy subsidy, tariffs on China. But then he wants to cut taxes, which is going to cost the government money. We need to make that up somehow if we don't want the deficit to continue to grow. So let's continue. They're going to talk about it. On the revenue side, we assume that TCJA tax cuts are extended at a cost of approximately $4.5 trillion over 10 years. That is why we need to cut. That's why Trump needs to cut the government and cut all the spending, is because of this, of what he wants to do. Now, this is gonna pass whether the cuts happen or not, unfortunately. We think the tariffs modeled in this scenario could bring in approximately $100 billion per year in new revenue, but retaliatory action by trading partners could require additional spending by the federal government, a dynamic observed in the president's first term. And we're already experiencing the retaliatory tariffs, mind you. Tariffs therefore have no net impact on revenue and in the baseline scenario. In addition, congressional Republicans are discussing whether to offset some of the cost through other budgetary savings, such as spending cuts or revenue raisers. Yes, and I know I keep going back to this, but this is like what they want to make money from right here. A few, at least. I don't know what else they have now in mind, but I know Trump, you could essentially buy a green card for like a few $1,000,000. That was previously it was a requirement that you needed to create 10 jobs and invest $1 million. But now you can just pay flat amount, which I don't know, I think that's fine. Whatever. I think it should be more because I think US passports are very valuable. So okay. But it definitely attracts a kind of person that doesn't necessarily benefit the everyday person, which is kind of what the government should kind of help. Okay. Spending cuts or revenue raisers. Overall, we forecast the federal budget deficit as a share of GDP to rise slightly from 6.2% in 2024 to 6.8% in 2025, before falling in the remaining years of the forecast as economic growth outpaces spending growth. Yeah, with the deficit as a share of GDP falling in the long term, we predict a 10-year federal bond rate will fall from 4.44% in 2025 to 3.395% in 2029. That's such a long prediction. Real estate and local government consumption and investment. Housing crisis, we have to think about that. We covered housing up previously. And then they said that a good way to help is government spending, whether that be local or state or federal. Real federal government consumption and investment, it goes down initially. Federal budget balance stays the same. Oh, yeah, here we go, state and local. Yeah, and I think we're gonna see a trend. Trump definitely wants to push a lot of he wants to give states a lot more power, and I think that's going to slowly start to see their effect, especially now that they're closing a lot of things in the federal government, like this Consumer Financial Protection Bureau, which is protects consumers, education department. Those are likely going to be picked up by primarily probably blue states, because I just can't see the red states taking that on too much. because, you know, lower education kind of benefits them in a way. Housing scarcity is just not good all around, so I don't really know about that. But yeah, so this is interesting that we could kind of see that the states are going to be more consistent, I guess. Maybe I don't know what, like, we could see these years, but this is like COVID, so this is not super consistent. But like we see in 2018, that's like about the same. Okay, labor markets. I need to use the restroom real quick, and then we'll continue. BRB, 2 seconds. Oops, labor markets. At the time of writing, labor markets continue to be healthy with strong job growth and low levels of layoff. This is the similar sentiment that the Jerome Powell, the Federal Reserve, said. Notably, though, it does take more time to get a job. The unemployment rate came down to 4% in January 2025, while non-farm payroll increased by 143,000, only slightly below the 12-month average monthly gains of 166,000 observed in 2024. Unfortunately, this is like totally not related to this forecast, but I do wish that they put more weight in the like quality of the jobs, because sometimes, like, if these jobs are just like minimum wage, no benefits, no nothing, it, like, I don't know, it's not like the best. But if we have like more high quality job growth, I feel like that's like a better indicator. That's besides the point. Okay, in the long term, demographics are the most important determinant for labor markets. On that front, perhaps the biggest question mark remains the new administration's immigration policy. According to recent estimates from the Migration Policy Institute, there are approximately 13.7 trillion million undocumented immigrants in the United States as of mid-2023. Yeah, agreed. Jobs don't benefit greater society. Yeah, I'm sure they mean something else, but I don't know. This has probably gone down significantly, not even from deportations too, but I know a lot of people were like pre-leaving. A lot of immigrants were like pre-leaving so they don't get deported. Like, so I wonder what this is now. No benefits from job and no help from the government. You're in a bad spot. Yeah. Yeah, fortunate. Around 3/4 of them are part of the labor force. That's so many people. 3/4. That's several million people, though they are not evenly distributed across industries. Some industries rely on much more on undocumented workers, according to the Department of Agriculture. Yeah, and again, this report has come in such clutch for like charts to illustrate what they're showing. Yeah, right here. These are the share of employees who are likely unauthorized immigrants and where they work. Landscaping, households, building services, crop production. Some industries rely much more on undocumented workers. According to the Department of Agriculture, 42% of agricultural workers are undocumented. Wow. Thus, the impact of deportations on labor supply and therefore on wages and prices will differ significantly across sectors of the economy. Overall, fewer people in the labor force would translate in a slower pace of job growth as employers struggle to fill some positions. And again, kind of going back to the manufacturing argument that I'm saying, where the manufacturing jobs are hard, they're hard jobs. Agricultural jobs are in a similar position. Like, they're hard jobs, like it's hard work, and not a lot of people want to do that when they could do a comfy office job instead. And again, that kind of goes back to this 3-sector model where, most of the time, developing countries will do that work for us, or at least we get workers from there, and they kind of do this work where like a more advanced economy like could focus on more advanced stuff. It's an interesting problem. I don't know how to solve it. During the election campaign, Vice President Vance indicated that deportations could reach 1 million people per year under the new administration. They talked about this in their forecast above, and they said it was they said the max was like 250,000. And actually, going back to this, even in the peak Bush, of course, good old Bush, it was like 40,000. It's like, a year. 1 million people a year? That's crazy. Like, Obama did way more. This would represent a quadrupling compared to the figure from the previous administration, and this level of deportation would result in very weak or even negative population growth over the forecast, with knock-on effects for labor markets. Yeah. And notably, Vance is a supporter of increasing the child tax credit. Like, he thinks he should increase that because, that also incentivizes people to have kids when the cost isn't as, they don't have a much burden on cost for the child, which would help population growth and kind of make up for this. But again, that would cost the government money, and Trump is in the negatives right now. He needs to cut more because the tax cuts, the TCJA tax cuts, are going to cost a lot of money. However, to date, we have not seen evidence of that magnitude of enforcement action. Since January 2025, 37,000 people have been removed from the United States, below the 2024 pace of deportations. This is Biden. I've been reading a few things about the deportation, but I haven't looked into it that much because it seems like a lot of it's being stopped, or the lower courts are doing a lot to stop it, I guess, or at least slowing it down. That's what I was looking for. So the government isn't that efficient at cutting everything. Won't save much. Who knew? Yeah, but that was known before going into this. I think while you're gone, we looked at so many charts and shit. Here we go. Yeah, this is what the goal: reduce 500. So the Doge's goal is to reduce $500 billion in spending. That must cite in Wall Street Journal piece as being unauthorized by Congress, and cut as much as $2 trillion from the $6.75 trillion in fiscal year 2024. Oh yeah, just my tool. Yeah, exactly. But no, it's exactly. That's kind of the case. There's still time, but I think they expected it to be easier than it is. Same with tariffs. I think they expected tariffs to not get as much retaliation. Okay. Ongoing appointments and staffing changes at Immigration and Customs enforcement could potentially lead to further deportations over the rest of the year. For now, though, our baseline scenario expects an additional 100,000 angel deportations compared to the previous administration. Yeah, and I think once they figure it out, sure, they probably will increase it, but I think they're getting a lot of things ironed out still. The current administration has acknowledged that lack of budgetary resources impacts its ability to deport undocumented migrants. That's ironic, I guess, in a way. Interesting. They have asked Congress for $175 billion to help facilitate the immigration enforcement and border security efforts. And I think this was passed with the recent spending bill, now that since Schumer and a few Democrats voted for it. I think they got this, or at least some of it. For readers interested in the implications of this immigration policy approach, our downside scenario assumes deportations reach an additional $250,000 per year, which is below the $1 million used in our downside scenario in our previous forecast. Yeah. During the president's first term, there is no major change in legal immigration levels. We therefore do not have any changes to legal immigration levels in any of our scenarios. Wow. Another factor that will affect employment levels this year are the ongoing layoffs in the federal government. So far, more than 75,000 government employees have accepted buyouts, and the administration has said it will lay off 220,000 federal employees still on probation. However, the removal of probationary employees has been challenged in the courts. And it's not even that much money, like we saw above. All things considered. We expect strong job growth to continue in the first quarter 2025, but a slower pace for the remainder of this year and next. That's interesting. I assume that there would be some. I assume there would be some in areas where immigration is high, like agriculture, and where we want to make jobs with tariffs, like manufacturing. But I guess, though, they kind of said it earlier, it's going to take a long time for those to actually come through. Although the unemployment rate fell in January, we expected it to rise again throughout 2025 and the first half of 2026. Dang, even that long? As the private sector struggles to incorporate the potential wave of newly unemployed government workers. Yeah, and they talked about this earlier, where it's like, we need to absorb all these workers. It's going to take time and also cost a lot of money. It costs the government money. That would cause the unemployment rate to rise above 4.5% by the third quarter of 2025 and remain elevated for the remainder of the forecast period. Yeah, and it just takes so long to get jobs. Employment to population ratio. Interesting that this keeps going down. Employment cost index? That's interesting. Okay, financial markets. This is so short. Stock markets have shown volatility since inauguration. S&P 500 down slightly from its level of January 2025. At the time of writing in late February. Heightened uncertainty has also caused the US dollar to weaken after posting strong post-election gains. Yeah, okay. Since the FOMC began its rate cutting cycle, it cut rates worth 100 basis points, 1%, bringing the Fed's range to between 4.25 and 4.5%. However, policymakers are now entering a period of hard choices on interest rates. Yeah. In our baseline scenario, we think the Fed will only manage to cut rates twice this year. Yeah, I think that's optimistic, though. Maybe they do need to cut rates, though, with kind of like this unemployment coming up. They need to stimulate the economy a little more. Poke and prod it a little bit. In our baseline scenario, we think the Fed will only manage to cut rates twice this year. Stubborn inflation will slow the speed at which interest rates can be brought back to neutral. Also, I mean, like, I definitely trust their opinion. I'll just say that, like, I'm just some guy, but yeah. With rates finally settling at 2.875 in December 2027. In all scenarios, we expect the FOMC will maintain its independence and with its mandate remaining unchanged. This is important too, because Trump publicly has said that he doesn't like Jerome Powell. He wants to fire him. Jerome Powell when asked by reporters, actually specifically stated, it was like, what do you like? Are you going to quit now that Trump's elected? Or like, are you going to, leave your position? And he's just like, no. That's all Jerome Powell said. And he's like, I have nothing more to say. In the last meeting too, someone asked him about it again. And he's like, I'll refer back to what I said previously, which is just no. So it's important that they say this, because if Trump does somehow take over the Federal Reserve or like input someone, Jerome Powell's term I think is up in 2027 or 2026, and that in that case, there'll be a new chair of the Federal Reserve. Trump could put a crony in, or someone who's a loyalist, and they could kind of fuck with things and go against the Federal Reserve being independent entity from Congress. They, that's the benefit of the Federal Reserve, is they're not political, so they can make hard decisions that might not get them elected in the future, or that may go against the president's wishes, but ultimately they don't care. Like they shouldn't care, the Federal Reserve, because they have other mandates. Jerome Powell always says like their mandates like reduce prices or like maximize employment, like those two things. So this is I think an important call out. It was like 0%. It's unfortunate though that mortgage rates are going to take so much longer to fall. Like this sucks really bad for people trying to buy a house. Household wealth stagnant. Interesting. Okay, prices. After falling through the summer and into the early fall 2024, year-on-year consumer price index, CPI inflation for all items has started to rise again, returning to 30% in January. With prices increased for a wide range of products and services. What caught people's attention was the 15% increase for the price of eggs, the largest rise recorded in almost 10 years. In addition, the Fed preferred measure of inflation, the personal consumption expenditure deflator, came in at 2.6% year over year in December, moving further away from the Fed's target. Yeah. And I don't know, like, I wonder if they'll see tariffs about like if those will affect inflation, but I don't know how much that'll have like a direct impact on inflation. It might have an impact on prices, but I think that is like that's like a different reason. So I don't know if they count that. I don't know exactly what data the Fed takes in. Perhaps even more worryingly, from the Fed's perspective, consumers' expectations of future inflation are starting to rise as well. In the conference's board's February survey of consumer confidence, forward inflation expectations shot up from 5.2% to 6% in the University of Michigan's February survey. But to be fair, Jerome Powell did say that, like, opinion is different than like action. So forward inflation expectations rose from 3.3% to 4.3%. Because inflation expectations tend to feed through into actual inflation, the Fed's role involves controlling not only real prices, but also expectations of inflation. that like makes things so murky. These data points, as well as the potential inflationary effects of tariffs, will give the FOMC a pause when considering if further interest rate cuts are appropriate. Overall, we expect CPI inflation to remain stubbornly high in 2025 at 2.8%. Yeah. Over the forecast period, we expect CPI inflation to remain above 2%, limiting the speed at which rates can be brought back down to neutral. I feel like 2% is... Yeah, I guess 2% is their goal, so they're saying if it remains above 2%. Yes, this is it was good here. All things considered, though, like I feel like it's like inflation's like it's okay, but the consumer price index doesn't include a lot of important things. I think like housing and like gas and oil or like cars. Like it's kind of like cherry picked in a way. Yeah, it doesn't. It like doesn't include some of these like food and energy or something because like energy's cheap. Um. Yeah. Okay. All right. I guess that was it. That was the end. Appendices. Oh, so this is their like. Oh, okay. So this is their uh forecasts. Just we could just skim this real quick. So this is the baseline. What is this inventory accumulation? I feel like this inventory accumulation is a good indicator of things people are not buying. Export and imports. Yeah, huh. I just got a notification about Trump cutting grants, so $12 billion. And that's the unfortunate part, I think, with the cuts is like realistically, he's going to have to just penny pinch and cut things that are smaller but that are probably more valuable. Like he just cut grants used for like infectious diseases and stuff. Like that's gonna be the unfortunate, like I think like hidden cost of doing these cuts is that like we're gonna cut things that we're not gonna see the downstream effects for like years, and it's gonna be too late by then. I mean, in that there's a lot like to consider about next election and everything, but yeah, this is interesting. Uh, Fortunately though, I don't think this was like super negative. Like overall, it's like it's just gonna be. I think they're calling it like a soft landing or whatever. Like, yeah, it's like the market's kind of mushy right now, or at least I feel like to summarize this, like they're going to the markets the next few years. The economy's gonna be a bit mushy. Like we're gonna have to ride out some of these initial pains of like Trump policy. There's going to be other downsides, I'm sure, that we haven't like discovered yet due to some of these like random things like deportation, like the cutting of some government programs. Like I'm sure we're gonna see some hidden things from those. We may not, and that would be good. But I yeah. So this is interesting. It's also interesting now that this is the second, this one by JP Morgan Chase. Now this one I think is a bit more opinion. This is a bit more opinion, but it's backed by data. And so I think that they both have the opinion that they're not going to cut enough to offset what Trump wants to do with like tax cuts and everything. And I think this is an important chart too, because when they talk about deregulation, but like the US already has like the lowest regulation out of like most modern economies. It was a good article on Shaw about tariffs specifically. Look it up. This one? I unsubscribe from Shaw's emails. You're sending me too many. This guy, I see this guy. Not this. Is it this one? Yes. Okay. Take a quick look at this. April 2nd may be one of the most important days of the year for investors. U.S. is preparing to announce new and higher tariffs on a wide range of imports across many countries. Here's our assessment of the when, what, where, why, where, and how. When. On April 2nd, the scale of President Trump's tariffs is likely to be unveiled, even if the implementation is again delayed. On February 13th, President Trump signed... Okay, let's skip this. Here we go. They couldn't get any. Someone just screenshotted their Excel document. Like, they couldn't spice this up a little bit. Signed a presidential memorandum ordering the developments of comprehensive study involving tariff and non-tariff barriers imposed by other countries before setting specific rates. Okay, 25% tariffs on autos, chips, and drugs. 25% tariff on cars. Semiconductors, pharmaceuticals could be confirmed on April 2nd. Okay. 25% on the EU. And potentially Canada tariff in Mexico. Agricultural products. Bro, agriculture is going to struggle so much, especially if the deportations continue, because they're going to have slower workforce. In a social media report, Trump said he would be imposing tariffs on imports or external agricultural products. I actually read something that last Trump administration, they imposed, there were some tariffs or something on agricultural products, and the government actually spent more money than they would have made, essentially like doing goodwill for farmers who got fucked over by the policy. So we'll see if they expect that now, this time around. Okay, so April 30th now. On January 20, Trump issued an America First trade policy, presidential memorandum directing agencies in the USTR to evaluate key aspects of the U.S. trade policy and the issue reports of the president. Okay. Officials to close the matter report that President Trump will announce widespread reciprocal tariffs on nations or blocks, but is set to exclude some, and the administration is not yet planning separate sectoral specific tariffs to be unveiled at the same event, yet they may be coming. A mid-March meeting between the Secretaries Lutnick, U.S. Trade Representative Greer, and Canadian officials, included the Ontario Premier and the Ambassador to the U.S., revealed that the high-level elements of the coming tariffs may include a shift in tariff emphasis from country-by-country basis to an industry-by-industry. Interesting. The details are likely to be complex, with potentials for individual tariff rates up to 17,000 different product categories across 190 different countries. I kind of, in that interview with Ezra Klein did with that PhD anthropologist and Financial Times reporter, she said that they kind of have different buckets that they're putting countries in. This is like theory that, I don't know how true. And that that is what's determining the kind of tariffs. And like, if you're an ally and you could like give us something in return, you go in a good bucket. If you are gonna like fight us, then you go in the bad bucket. And then there's like a middle bucket where it's like we just kind of need them for certain things, or like, we could get something out of them still. And that's kind of going to determine foreign policy, kind of based off of just like what benefit the US has to them. And that could like influence tariffs. It'd be crazy. While the US calls the tariff rate reciprocity, the rate appears to be unconnected to the import tariffs applied by other countries, making them fluid and hard to predict. Yeah, I mean, countries may be able to negotiate lower rates on targeted industries by aiding U.S. objectives. Literally, like that aligns with this. Why? In economic or fiscal policy, the tariffs are unlikely to benefit the United States. Abundant research, along with the most widely used economics textbook, Mankiw's Principle of Economics, Samuelson's Economics, for example, show that higher tariffs tend to restrict productivity and growth while raising prices. Fiscally, tariffs will not cover the cost of extending the 2017 tax cuts, even using the most favorable assumptions. This is now the third separate, independent, large bank, or at least consulting agency that has said this now. This is, Deloitte said it. Schwab is saying it now. This opinion by, JP Morgan, their private bank, it's a little different, but JP Morgan said it. However, at the geopolitical tool, tariffs are replacing sanctions as Washington's preferred methods of statecraft. Oh, this article is so good because yes, this is what they're trying to do. They're using it just as a tool, as leverage, achieving lower. But it's like it's not as like I feel like it's not as negative as like sanctions. Sanctions are like you're in trouble, but like tariffs, it's like there's no attachment like that to it. Maybe achieving lower tariffs to access the U.S. market is likely to require countries support. Support U.S. objectives. Yep. So it's like, you go in the green bucket if you could give us something in return or you support us. Demands may encompass immigration, drug trafficking, defense spending, purchasing U.S. energy, narrowing trade balances, adjusting taxes and currency values based on what we have heard from President Trump thus far. Yet countries may prefer to replace lost U.S. demand by stimulating their economies and lowering trade barriers among themselves as an alternative to acquiescence to shifting U.S. demands. And this seems to be already what's happening because Europe's like, shit, we need our own big tech. We don't rely on American big tech because of, the trust issues they're having now. And so they're like, let's just make our own, screw America. Or at least let's spend, domestically instead of giving it to American companies. Choosing to boost domestic demand is already underway in Europe. Specifically, German lawmakers passed landmark spending packages would allow for defense spending. Yeah, defense. From debt restrictions and sets up a 500 billion euro fund to invest in infrastructure. China is also increasing domestic stimulus. I mean, China is just like spends domestically like crazy. So, as we discussed in a recent article, making international great again? ? New bilateral trade agreements are also in the works. The most recent headline involving deals with India and the European Union, and India with New Zealand. Yeah. Might finish this tomorrow here. It's long. Yeah, this is interesting. Yeah, well, actually let's continue this tomorrow. I need to end here. Ugh. All right, I like this. This was an interesting read. I want to find more. I'm starting a list of more of like websites that release these reports because I really like reading these. This is probably one of my favorite stream contents. I need to find a audience that also finds this interesting. So I've kind of been posting more like my shorts. I'm going to focus on like economics, business, mixed in with emerging technology, how it impacts emerging technology. Tariffs won't really have that big of an impact. That's good, actually, I guess. Surprising, too. Besides policy changes and long-term effects. Dang. Yeah, I feel like all of this is kind of long-term, and it's so unfortunate because in terms of like political rhetoric, if all of the bad stuff happens during, a Democrat or the opposing, Trump faction, it's going to be blamed on the incumbent and not necessarily downstream effects. Like, no offense, the average, like the electorate is not just doesn't understand that, or they just don't really care. So yeah, it sucks. But I'm gonna add this to tomorrow's stream. What day is today? Today is the 26th. Boom. Dems need to be more aggressive in their blame. Yeah. Yeah. See how it is. Okay, well, actually, you should, wait, I'm gonna end on YouTube. Oh, wait, we're watching on YouTube, sorry. Hang on. Bro, the Ezra Klein show, man, he has such good guests on. I've just kind of been binging a lot of it. Watch this right here. Democrats need to face why Trump won. this dude is like a data science like polling bro for the Democrats, and so he has all the data. Like he has exactly the data why, and it's insane sometimes, like especially what people value over one another. Yeah, I'll send a link right now. It's actually crazy. And it kind of changed my perspective a bit on some things. So I would watch this. It gives an idea of like what the electorate kind of thinks. So yeah. All right, I'm gonna call it there. Thanks for watching Twitch and YouTube. Make sure to subscribe and follow. We'll be back tomorrow 9 a.m. for some more tech focused news. Maybe I'll do like the economic reports in the afternoon. Yeah. Thanks everyone for tuning in. We'll see you tomorrow, 9 a.m. Pacific. See ya. Oh, whoops. See ya.